Hi, everyone. I'm Rick Bensignor. Today is Tuesday, June 29th, and welcome to this week's In the No Trader Show. On tap this week, we'll look at macro markets. We'll look at the Dow Jones Industrial Average and the charts there to take a look at what we see. We'll look at the US dollar index, which has been rallying as of recent, and we will look at what the bigger picture is there. And we'll take a look at the dollar's rally and its effect on GLD, the gold ETF, which has been coming under pressure and continues to have more pressure today. In sector analysis, I figured, you know what, let's take a look at the infrastructure names. They have been moving significantly as of recent, with the infrastructure bill being bantered about and fought about in Washington. Stocks had a big move up. They've pulled back. Some are near their highs. Some have pulled back and continue to be in pullback mode. Let's take a look at a dozen or so of the names because they're very much in the news. And the question is there still a chance to make money in these, or has the market pre-priced already much of the potential up move? So we will concentrate on that in today's show. As usual, in order to write me an email, it's rick@inthenotrader.com. And to sign up for our weekly ETF Tactical Trader Report that comes out Thursday nights, go to In the No Trader for more information and to sign up, as well as the 7-11 monthly Spider Sector Report. Again, this is a report that aims to beat the S&P's return on an annual basis. So if you're not the type who wants to do a lot of trading, but you want to do better than the market, then this monthly Spider report is doing just as intended. We are outperforming the S&P as of May 31st by 341 basis points in the first 10 months since we started this last August 1st. So we are well ahead of what the S&P is doing. And again, if you're also managing, besides your own money, if you're a financial consultant and you are managing other people's money, this is a terrific report to be in. It's really simple. There's minimal tweaking. And if you can outperform the S&P, your clients will be happy. And of course, we're not taking a heck of a lot more beta than the S&P to do so. So this is a great way, without taking much more risk at all, compared to just being in a passive, let's say, Spider ETF. This is the way to go. So again, all the information is at inthenotrader.com on the sign up page. And that's where you can get subscriptions to both of those. All right, last thing we do before we get to the charts, individual charts, let's take a look at just how the sectors are doing. S&P, the SPY is up. The SPY is up 15% this year. Energy remains the best performer, up 44%. As I have said in the past, I believe that energy will outperform for the balance of the year. On pullbacks and relative performance, we will look to gain further exposure. It's the thing that has me confident enough in that is because with oil being where it is, if oil was at $40, I don't think energy would have this type of lead. But oil in the 70s, and even if it falls to the 60s, it will keep energy as the best performer here because they have been badly beaten up for so long. And even last year took out the 20-year relative low. In fact, took out the all-time low since XLE had ever started trading versus the spiders. So, when you look at that chart, energy's been a horrific investment relative to anywhere else in the market for the last 20 years. You would have been better off anywhere but in energy over time. This could be a meaningful change and the beginning of a bottoming process in relative terms to the S&P. And of course, again, it helps that the price of oil has doubled. But I do think that you want to have exposure in energy, and that on pullbacks, this will be a sector to look at, over time. Financials have now edged ahead of real estate for the second best performer last week. Real estate was the best, so financials have done a bit better as energy has pulled back, followed by communication services. And of course, if you go just right of energy in the middle of the chart here, you've got the three worst performers, all defensive sectors, staples, healthcare, utilities, well underperforming the market, although healthcare is not so bad. It's only trailing by about 300 basis points. So that's that. Let's go take a look. So we're going to go back here to this slide. And again, so this is what we'll take a look at. So we've got enough time this week, hopefully, to get through everything. We've got a dozen names in the infrastructure space. And let's look at the three macro things we're going to look at now, starting with the Dow Jones. So here's the weekly chart of the Dow Jones Industrial Average. Unlike the S&P, this actually has less signals and things to look at. I'm going to blow this up a bit. So the broken light purple uptrend line comes off of the 2020 March low. So that's this line. So we've broken beneath there. But more important is that you see there's several 13s here over the last few months, and we have been going sideways. And when you've been going up like this market has, so again, if I kind of just get us back to here. So here's the full move since the March 2020 low, which started down here. When you've been moving up like this as consistently as the market has, and you end up going sideways for several months, that's a change in trend. And that's what this indicator, this DeMark indicator called sequential, is aimed to do. It's to tell you, it's to essentially identify, in this case, in an uptrend, when it's not such a good time to be a buyer in the uptrend. In other words, generally, you'll have a better chance to buy at lower prices than when these signals show up. More aggressive people tend to become sellers at those levels, all the way down to the most aggressive who actually short against the 13s, which we occasionally do. But most important here is that with a market that's gone up, if you go sideways for months, you have a change in trend because there are three trends: up, down, and sideways. So sideways itself is a trend. And you can see that after this setup 9 count, which also is a piece of the 13 count, but many times itself ends up being a near-term exhaustion signal. Even this went sideways for months after the 9 count before the bull market took off again, and we made new all-time highs above this horizontal line, this dark purple one, or maroon, let's call it maroon. So, when you finally took that out, then you continued on the upside. So just knowing that, there's still some signals here. It's not calling for a massive decline. It's just saying you probably can get better prices than where these come in. Now, on the upside, if we break above, let's see, 34,968, then we can likely target something that's up here. Let's see, what do we have here? Next target would be 36,442 to 36,627, and beyond there, 37,900. On the downside, the most important thing is, as long as we're above 32,253, where this horizontal dashed dark purple line is, gee, everything seems to be in purple, then things are okay. Only if we break this and break it properly would it say that we would pull back all the way down to 29,400. Seems unlikely right now, but as long as we're still in a setup down count, so even after we got to 13, we're now in the third week in a row that if we were to close the week out right now, it's only Tuesday, but this is in real time, it says that this would be the third week in a row that the closing price is less than the closing price from 4 Fridays prior. As long as we're in a down count here, then I still say a little cautious. If we were to close, for instance, this week above the close from 4 Fridays back, 1, 2, 3, 4. So if this Friday we close above 34,756, or next Friday above 34,479, then you've taken this downside momentum away, and it makes me think more like we're going to head higher. But as long as we're staying beneath those closes from 4 Fridays back, there's still a negative bias here on the short term. And the negative bias doesn't mean you have to be bearish again. It just means that you don't have to necessarily chase and buy stocks at current levels. All right, so that's the Dow. Let's take a look at the US dollar index, DXY. And here's the weekly chart. So you can see, I'm gonna bring in a little more data. All right, so last year we had, just starting in 2019, we had 13 signals on the upside showing exhaustion so many times that were correct signals. Each 13 kind of got a decent sell-off. We finally spiked to new highs, and then that becomes the top, and then we've sold off since then. First week of 2021, downside exhaustion. We get a rally from 89 and change up to 92 and high change, actually past 93. We sell off, double bottom, put in a standard sequential 13. The darker purple one is aggressive sequential, just they count to 13s differently, and that's been the bottom since. So we've been telling clients that shorter term, the tactical trade is to the upside in the dollar. The question is this going to have enough strength to break out through this 92.89 level properly to then essentially target all the way up at 96.5? If that were to happen, you would have a lot of pain on Wall Street because, as I've said before, the #1 macro consensus trade going into 2021 is that the dollar would weaken. And the thing is, the dollar has not been any weaker since the very first week of this year. It made its low. It's exactly reminiscent to 2017, where the #1 trade that was the consensus macro trade going into 2017 is that the dollar would rally after Trump got elected in late 2016. You saw the dollar rally after he got elected, and most strategists on the street said the dollar would rally through 2017. It made its high the first week of the year and sold off the entire year. So there's a part of me, and I wrote about this earlier this year, that this could be the exact opposite. And with double 13 bottoms right now in the dollar, you have to kind of lean towards the dollar potentially doing better here. And because of that, there are implications for any dollar denominated stocks, what a stronger dollar will do for the stocks, what a stronger dollar does for corporate bonds and treasuries, and of course what it does for precious metals, which generally a stronger dollar is not good for precious metals, which will next lead us to our gold chart, which is definitely having trouble and deeply concerns me. Notice that the all-time high was made on a weekly 9. We sell down, and all the sell-off never had a real pattern to it until, and we couldn't call the definitive bottom until it actually did a 9 down. And the 9 down came very close to the trend line, which went way back. And now we rally, and 1 week before the high is a 9 up, and now we're selling off again. And we had broken the downtrend line to get to that 9 up. I'm awfully concerned now that we break the downside here of this uptrend line before we get a down 9. If it were to continue doing the same pattern, getting any significant close beneath this close from bar 1 on subsequent weeks makes me really concerned about gold's medium-term picture. The failure to truly continue along the way higher is problematic. The dollar rising is problematic. And the fact that we shook out shorts on this move, the last couple of weeks of the move on the breakout of the downtrend, only to see them pay up right at the high of the move, and you take out the whole short base, makes me concerned here that we're going to take out the long base here too and break through here and potentially, you know, get beneath 160.5 and trade lower to get beneath these lows. And if that happens, you're going to see a bigger decline, as this, you know, we should not take out March lows. If the fundamentals for gold are the way they are supposed to be, this should not be happening. So I am concerned about gold in here, and as long as we stay in this down count and continue, which we will for the next few weeks, barring a massive up move, we will continue this down count. 2 weeks from now will be important, because that's when we start relating versus. So if this goes to next week is week 4, week 5 gets a week 5 count if 5 closes less than 1, and 6 needs to close less than 2, 7 less than 3, it's less than 3, and so on. So despite the fact that we're still holding above this uptrend line, I am concerned about gold in here, and you know, we're just crossing on MACD here negatively. That's not particularly good either. Let me see where the 200-week moving averages must be way lower. There it is. Okay. So this, that dark blue moving average down there, again, somehow I end up with all the same colors. Let's just put a different color in there so it makes it easier. All right, so down here is the 200-week moving average. So we're not near that, but again, this is not a pretty picture for gold. So I am concerned. I'm not dumping out of my gold yet. I own a fair amount that have built up over the years, but I'm not loving the picture I see here near term. And it would have to, the GLD would have to get properly above 169.38 to change my feelings that it can get back up. So that's the story there, and that's the macro look. We've got 10 minutes or so, 11 minutes left for a dozen or so charts. We should be able to do that. So let's get to our infrastructure names. We're going to start off with Nucor. Now, I got the list of names that I showed you here. These names come from the ETF with the ticker PAVE, P-A-V-E. It's an infrastructure ETF, and these are the top dozen holdings in them. So I figured that's a good place to go find a bunch of infrastructure names. So we're gonna look at them one by one now as best we can. Here's a weekly chart on Nucor. Now, this dark blue line was the all-time high back in 2008. You can see that we stalled against it earlier this year, spent a month sideways, and then blew through going into April and May. So this, you're seeing the picture now of what's happened since. So there should be support if we get a pullback anywhere from what was the old highs, which was 83.5 down to 79.5 right now, is support from different levels. So interestingly, we're kind of still holding on to, except for this week, the pink line, which is the first line, the conversion line from the cloud model, and that's been support for the bulk of 2021, as it has been for the S&P too. So, you know, we're kind of hanging in here. And if we get a further pullback, I wouldn't mind getting this thing anything in the mid 80s for a bigger up move. TT, which is Train Technologies, been around much shorter time. Also has some 13s. Again, one weekly close beneath the pink line. Stronger, certainly stronger than Nucor is. Right now has upside target of 187 and change. It's 184, so that's a very close target. I don't have anything else here of significance for upside targets. support anywhere from 169 to 164 or so. That's the better place to buy it on a pullback if you get that chance. Eaton Corp, ETN, has been stalling also. One Friday close beneath the pink line, has come right back up. As long as it stays above 137, it's a healthy chart. If you break 137, look for 131 to 124. That's the place you want to be a buyer. Let's call it 132 to 125. That's where I'd look to buy this on a pullback. Kansas City Southern, KSU. Okay, so the high was made on aggressive 13. Last aggressive 13 was this here earlier in the year. We went sideways for weeks. Here you're getting the pullback. You have had a couple of this could be the third weekly close in a row that's beneath the pink line. Therefore, I'd look for this to pull back to 272.5. A deeper decline, 256-ish, somewhere in there is where you want to probably do your buying, especially here. Notice this is on a 5 count. As long as this keeps closing on Fridays beneath the close from 4 Fridays back, this still would have a negative bias. So I do lighter buying at, let's say, 272. And then as long as this count keeps going, I'd wait for a pullback towards 256 to do my best buying. Hopefully that is also comes when you get a setup 9 count, which this has not done on the downside. Looks like, yeah, the last setup 9 count was right near the lows in 2018. So we can get 9 weeks in a row that the close on Fridays is less than the close from 4 Fridays back. You're looking, you're much closer to having a real bottom. John Deere, DE, also known as Deere and Company. So this is already on a 7 count. Why is it 7? Because as of right now, the close is less than the close from bar 3, right? We're always comparing the close versus 4 bars back. As long as this stays in this count, you look for it to head lower. It's already gotten to its cloud baseline here in orange. So it may not go lower, but I'm going to use the 7 count and look at over the next couple weeks. If this week closed above bar 3, then you'd kill this down count, and then I'd say that these lows in here over the last 2 weeks are probably the lows. Otherwise, this has the chance to fall down to 278 from 332. That's pretty significant, but that would be what the target is. Well, the first target, sorry, is 316.70. And if in the next couple of weeks we get there on 9 count, then that's probably where I'm a buyer. Otherwise, this has room down to 278. On the upside, near-term target 368, and then looks like the highs. And notice the high stopped exactly at the propulsion full exhaustion level, which were these green bars here. Emerson, EMR. Okay, we had the 1 weekly close beneath the pink lines, come right back. It does have a kind of what I'll call a 13.9 top over the last 5 weeks or so, 6 weeks. Again, makes me think it's kind of going sideways. If this pulls back to 88-ish from the current 95-ish, that's the place to buy. Again, assuming that we still have a bull market for these names, that's the place to buy. Otherwise, you're a buyer down at 78. So again, you could do some buying here. And if we got a bigger decline, you do the bulk you're buying down here. Right now, 88.60-ish, somewhere right around 88.5 plus or minus 20 cents looks to be the key short-term support that's very meaningful since over the last few months. Sempra Energy. So we've got an energy name in the midst of this. SRE. Let's see how far we are beneath. Okay, so if that's all-time highs, notice on a 13.9, we plunked. It showed up perfectly before the 2020 decline. Since then, the only pattern that's shown up is a 9 up. We've basically gone sideways since. This you got a bunch of lows in here over the last few months that we look like we're just ticking beneath. So this could get down to, for two levels of importance are 128.5 and 119.20ish. Those are the two key levels here for this. Not this is the worst name we've looked at technically, well beneath its highs and peaking and looking like that they could take out these lows here and run more stops. And so this looks like it is heading lower. Vulcan Materials, VMC. So here's your all-time high. It's pulled back. You got a 13 last week. It's already confirmed because we're already in the midst of a down count. So I am not buying here. If we close this Friday beneath 172.5, and then next week we gap lower and trade beneath this week's low, whatever it ends up being, and close beneath this Friday's close, whatever it ends up being, that's a new bearish propulsion signal with a downside target of 150. So given how this looks right now, I'm not buying. I've got the 13. I'm in the midst of a 5 count. So this also looks like this could head down to the low 150s. That's significant percentage wise. So I'm not going to be a buyer in this in Vulcan right now. Parker Hannifin, PH, topped on a 13.9 count, pull back on a 7 count here. 7, it's 7 if it closes less than 3 this Friday. Next week would have to close less than 4, and in 3 weeks you'd have to close all the way under 281 in order to keep that count alive. Don't know if that can happen. At the same time, you've got a 12 count here towards the standard sequential, not the aggressive one, but like the red 13s, which can come next week. That makes this one a tougher buy in the scheme of things. So I think some of the other names are better than Parker Hannifin right here and right now. Norfolk Southern, NSC. Peaked about, I don't know, 6 weeks ago or so, been trailing off. Let's see, last week was an up close prior to the prior week if we close down. So if this Friday closes less than last Friday, and then next week we gap lower, make a lower low than this week, and a lower close than this week, you get a new propulsion sell signal with a target down at 241. That's $20 lower than we are. So this is the 3rd week in a row. This is trying to hang by the baseline. If that doesn't hold this week, look for it to get down to 241. That happens to also be the TDST line. So you've got 2 unrelated models that are both in that 241, 242 area. That's the place you do your buying over the next month or so. Fastenal, FAST. 13's on the top, 13's on the top there, same type thing, pulling back 5 count. Maybe you do a little light buying here and a little bit more just beneath. The main support's all the way down to 47 or so. And we'll get one last one in here. We'll quickly put it in. Union Pacific. Not much here, same thing, 5 count. Look for it to continue unless we can kill the down count. First support is 210-ish to 212. It's currently about 219. That's it for this week. Hope you enjoyed the show. I am Rick Bensignor. This has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.